It is undeniable that the Great Depression remains the most important and the most significant economic and financial crisis in contemporary history. What makes it truly unique is that it was by far the longest and most severe economic downturn in modern history, lasting roughly a decade and affecting much of the world. It was an amalgamation of sharp declines in economic output. U.S. GDP fell more than 30% between 1929 and 1933. Mass unemployment peaked at more than 25%, and the banking system failed. Economists and historians agree on no single cause, but a combination of factors turned a severe recession into a prolonged depression. There is an important difference between what caused something and what triggered it. The stock market crash of October 1929, Black Tuesday, is seen as the trigger, but not the primary cause of the Great Depression. It eroded confidence and wealth, but alone would likely have caused only a sharp recession. Let's first focus on what triggered the Great Depression. The Great Depression was primarily triggered by the crash of the stock market in 1929. Between October 24 and October 29, 1929, the U.S. stock market experienced its most intense time of tribulations. A sudden collapse in stock prices wiped out billions in wealth. Rampant speculation in the 1920s, with stocks bought on margin, borrowed money to invest. A widespread belief in endless price increases, easy credit, and new complex investment vehicles like leveraged trusts, all led to pushing stock values far beyond their real worth, thus overvaluing shares. The speculation around stocks created a bubble, an unsustainable expansion that eventually collapsed when interest rates rose and confidence faltered. Only 16% of Americans were directly invested, so its direct impact was limited. It amplified existing vulnerabilities. Moreover, the crash of the stock market triggered a bank run. A bank run occurs when a large number of customers lose confidence in a bank's solvency and rush to withdraw their deposits simultaneously. Indeed, many commercial banks had invested depositors' money in the stock market, directly or via affiliates, or held stocks as collateral for loans. The crash devalued these assets sharply, weakening bank balance sheets and making them vulnerable to insolvency. Even non-investors felt the impact, as the ensuing recession reduced spending and business activity. Fear spread that banks were overexposed to the market, prompting depositors to withdraw funds en masse to hold cash. At the time, there was no federal deposit insurance. The FDIC was created in 1933, so rumors of weakness could trigger runs. Depositors rushing to withdraw savings, forcing banks to liquidate assets at fire sale prices, often leading to failure. The first major wave hit in November to December 1930, e.g., failure of the Bank of the United States in New York, spreading regionally and nationally in 1931 and 1933. Over 9,000 banks failed by 1933, destroying savings and contracting credit further. What then caused the Great Depression? This question is generally answered through the Keynesian lens. John Maynard Keynes, the famous British economist who is known for publishing one of the most impactful books of economic theory in the 20th century, notably The General Theory of Employment, Interest, and Money, published in 1936, blamed capitalism, especially the unregulated market, for causing the longest economic downturn in modern history. Keynes believed the Great Depression was caused by a severe drop in aggregate demand, also known as total spending, due to reduced consumer and business investment, creating a vicious cycle of layoffs, lower incomes, and even less spending, which markets couldn't fix alone, necessitating government intervention. He argued that a fundamental lack of demand, fueled by pessimism and uncertainty, left the economy stuck in a low-activity equilibrium with high unemployment. According to Lord Keynes, the sharp decline in total economic output was the result of a decline in aggregate demand. He contended that the crash of the stock market led to a dramatic fall in consumption, and especially investment spending. Businesses, facing uncertainty and pessimism, reduced investment, while households cut spending. This created a vicious cycle. Lower demand led to reduced production, layoffs, and further drops in income and spending. Keynes doubled down on his explanation of the Great Depression by blaming the failure of classical economic theory when it comes to market regulation. Indeed, classical economics champions the idea of a self-regulating economy, believing markets naturally adjust to equilibrium and full employment through forces like supply, demand, and the invisible hand, minimizing the need for government intervention, with core tenets including Say's law, supply creates its own demand, and flexible prices/wages ensuring stability. Unlike classical economists, who believed markets would automatically restore full employment through flexible wages and prices, Keynes argued that economies could remain stuck in a low equilibrium state with persistent unemployment. Wages and prices are sticky downward, resistant to falling due to contracts, morale, and institutional factors, preventing quick adjustment. As a result, according to Keynes, the depression deepened and prolonged, rather than self-correcting. An initial drop in spending, e.g., investment, had amplified effects. Reduced spending led to lower incomes, which caused even more reduced spending, magnifying the downturn. In a nutshell, Keynes blamed market failure as the cause of the Great Depression. While the Keynesian view of the Depression has become the dominant narrative to justify its causes, this view is very much flawed. As a matter of fact, Keynes, in his explanation, did not factor in the role of the Federal Reserve and its monetary policies in causing the Depression. Nobel Prize-winning economist Milton Friedman, leader of the Chicago School of Economics, argued that the central problem that led to the Great Depression was a dramatic decrease in the money supply, rather than a drop in spending. In his magnum opus, co-written with Anna Schwartz, entitled A Monetary History of the United States, published in 1963, Friedman contended that the Federal Reserve failed to act as a lender of last resort, which allowed banks to fail and the money stock to collapse. The Federal Reserve's inaction triggered banking panics, leading to people hoarding cash, and banks stopping lending, freezing the economy. Indeed, the money supply fell by about one-third from 1929 to 1933 due to bank failures and the Fed's inaction or tightening, rather than injecting liquidity. Moreover, Friedman maintained that the shrinking money supply led to severe deflation, falling prices, increasing the real burden of debt, and further depressing economic activity by reducing spending power. This turned a normal recession into a severe depression. Thus, according to Milton Friedman, aggregate demand fell because of monetary contraction, rather than insufficient investment confidence alone. Hence, the government, via the Federal Reserve, was instrumental in causing the Great Depression. The Austrian School of Economics, led by Ludwig von Mises, Friedrich von Hayek, and Murray Rothbard, agreed that the Federal Reserve is primarily responsible for causing the Great Depression, but the reasons for which they agreed are drastically different from Friedman's. Unlike Friedman, who argued that the central bank should have done more to prevent the downturn from happening, which implies more interventionist policies, the Austrians argue that the central bank should have done nothing at all and let the market regulate itself. In point of fact, the Austrian school view blames the Great Depression on the Federal Reserve's manipulation of interest rates during the 1920s, creating an unsustainable credit expansion and widespread malinvestment, unprofitable projects, by artificially lowering rates below natural levels, distorting market signals. They argue this expansion led to overinvestment, especially in capital goods, and when the credit dried up, the necessary market correction, depression, was prolonged and worsened by misguided government interventions, like Hoover's policies and FDR's New Deal, that prevented the economy from self-correcting by propping up failing businesses and wages. The main evidence backing this argument is the rapid recovery in the 1921 recession, with minimal intervention, versus the prolonged 1930s downturn. Wartime recovery was illusory. Rationing, conscription hid unemployment. According to the Austrians, the Depression was a supply-side correction of prior distortions, not demand deficiency. Government spending crowded out private recovery and created a moral hazard. Why was the Depression the longest economic downturn in history? The Great Depression started in 1929 with the crash of the stock market and lasted through the 1930s. While the crash of the stock market was intensely brutal in terms of financial losses, the stock market began to recover on its own by 1932. This recovery could have ended the recession and not prolonged it into a depression. Why did the crash of the stock market turn into a depression that persisted for over a decade? It was, in fact, the interventionist policies of President Herbert Hoover and President Franklin Delano Roosevelt. Indeed, while mainstream historical narratives portray Hoover as largely passive and FDR's New Deal as a heroic intervention that alleviated suffering and spurred recovery, the reality is that both presidents' interventions distorted markets, stifled private investment, and prolonged the downturn. Contrary to the myth of Hoover as a strict laissez-faire advocate, he pursued aggressive government interventions starting in 1929, which economists argue prevented natural market adjustments like wage and price reductions that could have restored employment and output. His actions increased federal involvement in the economy, leading to distortions that worsened unemployment, which peaked at nearly 25% by 1933, and delayed recovery. President Hoover convened business leaders in late 1929 to pledge against wage cuts, aiming to maintain purchasing power amid falling prices. However, this artificially kept wages high. Real wages rose 20% from 1929 to 1933 due to deflation, making labor more expensive and leading firms to lay off workers rather than hire. Unemployment surged as a result, with estimates suggesting this policy alone contributed significantly to job losses. He also signed the Davis-Bacon Act, 1931, requiring, quote, prevailing wages on federal projects, and the Norris-LaGuardia Act, 1932, which protected unions and restricted injunctions against strikes, further inflating labor costs and reducing flexibility. These measures echoed earlier interventions as Commerce Secretary in the 1921 recession, but in the deeper 1930s downturn, they prevented the price-wage adjustments needed for recovery. Besides his high-wage and labor interventionist policies, President Hoover also implemented protectionist policies via the Smoot-Hawley Tariff in 1930. As a matter of fact, this raised duties on over 20,000 imported goods by an average of 59%, sparking retaliatory tariffs from trading partners, and collapsing global trade by 66% from 1929 to 1934. U.S. exports fell sharply, hurting industries like agriculture and manufacturing, and exacerbating deflation and unemployment. Economists estimate it reduced GDP by 1 to 2%, and prolonged the slump by limiting access to cheaper imports that could have lowered costs for consumers and businesses. Moreover, President Hoover provided loans and bought surpluses to prop up prices, but this encouraged overproduction, leading to even larger surpluses and further price drops. Farmers faced foreclosures anyway, and the policy wasted resources without addressing underlying demand issues. Government spending increased considerably under his presidency, which contributed to the prolongation of the recession. Federal spending rose 48% nominally, nearly doubling in real terms due to deflation, from 1929 to 1933, funding public works and relief, while deficits reached 4.5% of GDP. However, the Revenue Act of 1932 imposed the largest peacetime tax increase in U.S. history, raising top income taxes from 25% to 63%, corporate rates to 13.75%, and adding excise taxes. This reduced disposable income and investment, counteracting any stimulus from spending and contributing to a contractionary effect. President Roosevelt's New Deal, launched in 1933, expanded government dramatically, with federal spending tripling and new agencies regulating vast swaths of the economy. While it provided immediate relief and restored some confidence, critics argue it created uncertainty, raised costs, and suppressed competition, leading to no net private investment from 1930 to 1940, a $3.1 billion decline in capital stock, and unemployment averaging 17.2% through the decade. A 2004 UCLA study estimates these policies extended the Depression by 7 years, from an expected 1936 end to 1943, by inflating wages and prices 25% above market levels, and reducing GNP by 27% below potential. In 1933, during his first year in the White House, FDR enacted the National Industrial Recovery Act, also known as NIRA, as one of his core policies of the New Deal. This policy exempted industries from antitrust laws in exchange for codes setting minimum wages and prices, creating over 500 cartels covering 80% of non-agricultural employment. Wages rose 25% above productivity-adjusted levels, leading to massive layoffs, e.g., 500,000 black workers in textiles. Prices increased 23%, reducing demand. Even after the Supreme Court struck it down in 1935, reduced antitrust enforcement, from 12.5 cases per year in the 1920s to 6.5 in 1935 to 1938, allowed practices to persist, with wholesale prices 14% inflated. This is credited with causing 60% of the weak recovery and the 1937-1938 Roosevelt recession, GNP down 18%, industrial output down 32%. In 1935, FDR passed a series of labor policies under the National Labor Relations Act, also known as the Wagner Act. This law doubled union membership and tripled strikes, from 14 million days in 1936 to 28 million in 1937, driving wages up and prompting layoffs. E.g., GM cut 25% of staff in 1937-1938. This raised unemployment by 8 points by 1940 and disproportionately harmed unskilled workers, including African Americans, by pricing them out of jobs. Furthermore, the Agricultural Adjustment Acts, 1933-1938, destroyed crops and livestock to raise prices, increasing food costs for the poor and displacing black sharecroppers. Relief like the WPA and FARA skewed funds politically, less to the needy South, more to swing states, while projects like the TVA flooded lands, displacing 15,000 mostly black farmers without aid. The New Deal policies led to tax increases and regulatory burdens. Certainly, federal taxes doubled from $1.6 billion in 1933 to $5.3 billion in 1940, 3.5% to 6.9% of GNP, including higher income, corporate, estate, excise, and Social Security payroll taxes, plus the undistributed profits tax, 1936. This reduced investment and job creation. Securities laws, 1933-1934, made raising capital costlier, with fewer firms issuing stock post-SEC. FDR's rhetoric against business also created uncertainty, deterring investment. Real GDP grew only 1% annually from 1929 to 1939, far below trend, and full recovery didn't occur until World War II mobilized resources, though some argue war spending, not the New Deal, ended it. That being said, who is responsible for causing the Great Depression? The Federal Reserve, via its monetary policies, caused the crash of the stock market to occur as a recession, and the policies of Hoover and FDR prolonged the recession into a depression.